So let us discuss another topic under PAS 8. So again, there are three topics under PAS 8 that includes change in accounting estimates, accounting policies, and correction of prior period errors. So in this video, we are going to discuss change in accounting policy. So in our first video, we have compared accounting estimate with accounting policy. So we have defined accounting policy as specific principles, bases, conventions, rules, and practices applied by an entity in preparing and presenting financial statements. So if there is a change in accounting policy and accounting estimate, we should properly identify if such change pertains to an estimate or a policy, because the accounting treatment for the change in accounting estimate differs from the accounting treatment on change in accounting policy. However, there are times that it is really difficult to identify whether such change pertains to an estimate or an accounting policy. So if that is the case, the standard provides us guidelines that we can follow when the determination of the change, whether as an estimate or policy, is difficult. So under PAS 8, paragraph 35, a change in the measurement basis applied is a change in accounting policy and is not a change in accounting estimate. When it is difficult to distinguish a change in an accounting policy from a change in an accounting estimate, the change is treated as a change in accounting estimate. So this means that after you have tried all effort to identify whether a change is a policy or an estimate, however you are still unable to determine the nature of such change, the standard states that it shall be treated as a change in accounting estimate. Now, since the focus of this discussion is accounting policy, let us proceed to the guidelines of selecting accounting policies applicable to a particular entity. So according to PAS 8, we have two sources of accounting policy. First is the standard, which are the IFRSs. So the accounting policies shall be based on the applicable IFRS. So if the entity has a transaction and there is an applicable IFRS to such transaction, such IFRS shall be applied as an accounting policy. However, if there is no IFRS applicable to a specific transaction, this time the entity shall use judgment in developing and applying an accounting policy. So according to the standard, in making judgment, the following sources must be considered as stated in paragraph 11A, B, and paragraph 12. So the provisions under paragraph 11 and paragraph 12 are the sources of accounting policy when the entity will use judgment. So let's start with paragraph 11. So this shall be in descending order. So letter A, the requirements in IFRSs dealing with similar and related issues, and the definitions, recognition criteria, and measurement concepts for assets, liabilities, income, and expenses in the conceptual framework for financial reporting. And in paragraph 12, a source of accounting policy could also be the most recent pronouncements of other standard-setting bodies as long as these do not conflict with sources in paragraph 11. So these are the sources of accounting policies in case there is no applicable IFRS to a specific transaction and the entity will use judgment in the selection of accounting policies. Then, unlike accounting estimate, accounting policies should be consistently applied to similar transactions over time, because accounting estimates may vary. It means that the estimate for this year could be different from the estimate for the succeeding years because the nature of estimates is really variable. However, to ensure comparability, accounting policies should be consistently applied. That is why the standard states that an entity shall select and apply its accounting policies consistently for similar transactions, other events, and conditions unless an IFRS specifically requires or permits categorization of items which different policies may be appropriate. If an IFRS requires or permits such categorization, an appropriate accounting policy shall be selected and applied consistently to each category. However, if it is inevitable and an accounting policy should be changed, in order to ensure comparability, the accounting treatment, if there is a change in accounting policy, first should be based on the transitional provision. But in the absence of the transitional provision, it shall be accounted for retrospective. So the accounting treatment would be retrospectively in order to ensure comparability so that the accounting policy will be consistently applied since the start until the current year. So to better understand the application of the standard on the change in accounting policy, let us answer an illustrative problem. So let us answer a problem for change in accounting policy. So let us read the problem. ABC company has the following combined income statement and changes in retained earnings during 2019 and 2020. So in 2020, the entity changed its accounting policy in costing inventory from using Fifo method to weighted average method. The inventories under both inventory costing method are as follows. The requirements are to prepare the revised comparative income statement for 2019 and 2020, as well as the revised comparative statement of changes in retained earnings for 2019 and 2020. So this problem is focused on the change in the accounting policy on inventory. So based on the problem, the accounting policy used by the entity originally in costing its inventory is the Fifo method. Then in 2020, it changed its accounting policy to weighted average method. Again, when there is a change in accounting policy, our accounting treatment would be based on the transitional provision. However, if there is no transitional provision, it will be accounted for retrospectively. So for this particular type of change in accounting policy, particularly for a change in inventory costing method, our treatment would be retrospective. Since the change in the accounting policy would affect the inventory of ABC company, so in the income statement, the account that is directly affected by the change is the cost of sales, because the change in the accounting policy would have a significant effect on the cost of sales. And the cost of sales presented to us in this problem is computed using the Fifo method. And there are information given below related to the ending inventories computed in both inventory costing method for each year from 2018 to 2020. So first, let us reconstruct the computation of cost of sales using Fifo method. So let us start with 2019. The cost of sales in 2019 is 880,000 pesos. And if the cost of sales of 880 in 2019 is based on Fifo method, it means that when it computed for its cost of sales, the ending inventory used by ABC company is the ending inventory in 2019 using Fifo method, which is 88,500. So this is the ending inventory in 2019. So which means that the cost of goods available for sale in 2019 is 968,500. And this is computed as 880 plus 88,500. So that is 968,500. Then the beginning balance in 2019 of our inventory, of course, would be the ending balance in 2018. So that is 96,000 pesos. Then after this, let us determine the purchases. So the purchases will be squeezed. So this will be 872,500. So that is computed as 968,500 minus 96,000 pesos. Now let us reconstruct the cost of sales for 2020. So again, for 2020, the cost of sales is 800,000 pesos. That is based on the data given. Then the ending inventory in 2020 using Fifo method is 80,000 pesos. And the cost of goods available for sale is 800 plus 80. So that is 880,000 pesos. Then again, the beginning inventory would be the ending inventory in 2019, which is 88,500. That is why our purchases, which is the difference between 880,000 and 88,500, is 791,500 pesos. So this is the computation of the cost of sales of ABC company if the inventory costing method used is Fifo method. Now, let us recompute the cost of sales of ABC company, assuming ABC company uses the weighted average method. So since from Fifo, the inventory costing method will be changed to weighted average method, and since the change in accounting policy is accounted for retrospectively, it means that the effect of the change must be reflected in the prior periods as if the revised accounting policy has been already applied since the start. So it means that as if the Fifo inventory costing method has never been applied at all. So since this is retrospective application, let us recompute the cost of sales of the entity using the weighted average inventory costing method. And our recomputation of the cost of sales would not only be in 2020 but also for 2019, because again, our accounting for change in the accounting policy would be retrospective. So again, let us start with 2019. So that will be beginning inventory. So that will be beginning inventory for 93,000. So this is the ending inventory in 2018 using the weighted average method. And our purchases is 872,500. Again, the 872,500 is taken from our computation above when we reconstructed the cost of sale computation under Fifo method. So that is 872,500. Then the cost of goods available for sale computed under weighted average method is 965,500. Then let us deduct the ending inventory in 2019 computed under weighted average method, which is 90,000 pesos. Then the cost of sales in 2019 using average method is 875,500. Then for 2020, the beginning, of course, would be the ending inventory in 2019. So that is 90,000 pesos. Then the purchases, again, will be taken from the purchases computed under Fifo method, 791,500. Then the cost of goods available for sale is 881,500. So that is 90,000 plus 791,500 pesos. Then let us deduct the ending inventory computed under weighted average, that is 95,000 pesos. So the cost of sales of the entity using average method in 2020 would be 786,500. So after we have recomputed the cost of sales, let us prepare the revised income statement for both 2020 and 2019. So let's start with the sales in 2020. So that is 2 million. Then the cost of sales, of course, computed under weighted average method is 786,500. Then the revised gross profit in 2020 is 1,000,000 to 1,350,000. Then the operating expenses is still at 960,000 pesos. Then the revised net income in 2020 is 253,500. And in 2019, since again this is a retrospective application, the effect of the change in accounting policy must be reflected in the earliest prior period presented, which is 2019. So that is the earliest prior period from 2020 that is presented. So basically, at the minimum, the comparative financial statement would include a comparison between 2 years financial statements. However, there are some industries where the comparative financial statements does not include only 2 years of financial statements. There are industries that require 2 or more years financial statement to be presented in the comparative FS. So here, the earliest prior period is 2019, and the change in accounting policy must also be reflected in 2019. So the sales in 2019 is 2,200,000. Then the revised cost of sales in 2019 is 875,500. So the revised gross profit is 1,324,500. Then the operating expenses is at 1,056,000 pesos. Then the net income is 268,500. That is revised, computed using the weighted average method. So these are the revised net income. So that is computed based on the weighted average method. So in this problem, we are able to prepare the revised income statement for 2020 and 2019, since the information on the computation of the net income are given. However, there are problems that would only provide you the amount of unadjusted net income, and the requirement will be to compute for the adjusted net income. So what will be the procedure if the only given information is the unadjusted amount of net income as well as the retained earnings, and there is no more detailed information in the computation of the net income? So the procedure will start with the comparison between the ending inventory under the two costing method. So let us start with the Fifo method. So again, based on the problem, the ending inventory under Fifo method on December 31, 2020 is 80,000 pesos. And on December 31, 2019, the ending inventory is 88,500. And on December 31, 2018, the ending inventory is 96,000 pesos. Then for weighted average method, the ending inventory in 2020 is 95,000 pesos, in 2019 90,000 pesos, and in 2018 is 93,000 pesos. So let us now start the analysis. So this is by determining the overstatement and the understatement in the ending inventory. So let us start with 2020. So since the entity uses currently the Fifo method, it means the net income of the entity used the 80,000 pesos ending inventory in the computation of cost of goods sold, which is lower or understated compared to the 95,000 ending inventory under weighted average. So which means that the 80,000 pesos is understated by 15,000 pesos. Then in 2019, the inventory under Fifo is 88,500, while under weighted average, the ending inventory is 90,000 pesos, which means that the inventory under Fifo is, again, understated by 1,500. So the overstatement or the understatement are the differences of the ending inventory between the two costing methods. Then on December 31, 2018, the ending inventory that was used in the computation of the cost of goods sold for 2018 is 96,000 pesos, which is greater or overstated compared to the 93,000 ending inventory under weighted average. So that is why the ending inventory in 2018 is overstated by 3,000 pesos. So after we have computed for the understatement and overstatement of the ending inventory, let us analyze the effects of these understatement and overstatement on the entity's net income. So to start our analysis, let us use this illustration. So this illustration shows the relationship between real accounts from another real account and the relationship between a real account and nominal account. So let us first start with the assets and income. So between asset and income, the relationship is direct. It means that if the asset is overstated, it means that the income is also overstated. And if the asset is understated, its related income is also understated. So same rule applies to expenses and liabilities. So expenses and liabilities have, again, a direct relationship. However, for assets and expenses, the relationship is inverse. It means that when an asset is overstated, its related expense is understated. And if an asset is understated, the related expense account is overstated. Then same rule applies between income and liabilities because income and liabilities have inverse relationship, as well as asset and liabilities and between income and expense. So they have inverse relationships. Now let us apply these concepts in the analysis of the overstatement and understatement of the ending inventory on the net income of the entity. So our analysis will start with the unadjusted balance, which is computed based on the old accounting policy. So this will be for the retained earnings and net income for the years 2020 and 2019. So I've added another column for 2018 so that our analysis on the effects of the prior period error will be complete. So let us start with the ending balances of the retained earnings in these years. So starting with the ending balance of retained earnings in 2018, so which is the beginning balance for 2019. So this is 250,000 pesos. Then add the net income in 2019, which is under Fifo method. This is 264,000 pesos. Then the retained earnings at the end of 2019 is 514,000 pesos. And this is based again on the problem. Or it could be computed as 250 plus 264 is equals to 514, assuming there is no dividend payment. Then let us add the net income in 2020, which is 240,000 pesos. Then the retained earnings at the end of 2020 is 754 pesos. Then now let us start the analysis of the understatement and the overstatement of the ending inventory, starting with 2018 inventory. So the 2018 ending inventory is overstated by 3,000 pesos. And ending inventory is an asset which appears in the statement of financial position. And since the ending inventory that appears in the statement of financial position is overstated by 3,000 pesos, again, the relationship between an asset and net income is direct. So it means that the net income in 2018 is also overstated by 3,000 pesos. So in order to convert the net income into weighted average computation, we need to deduct the 3,000 pesos from the 2018 net income. So that is a deduction of 3,000 pesos. However, we cannot determine the adjusted net income for 2018 because there is no information about the unadjusted net income in 2018. However, I just included this adjustment so that I can show you the complete analysis for the effects of the change in accounting policy for inventory. Again, the adjustment will be a deduction from the 2018 net income of 3,000 pesos because the net income is overstated. And again, why is it overstated? Because the ending inventory, which is an asset, is also overstated by 3,000 pesos. And then, since the net income in 2018 is being close to retained earnings, it means that the net income that was close to the 250,000 retained earnings at the end of 2018 is also overstated by 3,000 pesos. So which means that in order to convert the retained earnings of 250,000 pesos to weighted average computation, it means that we need again to deduct 3,000 pesos from the 250,000 retained earnings. So what will be the effect of the 3,000 peso overstatement of ending inventory in the succeeding years? So since the ending inventory in 2018 will become the beginning inventory in 2019, it means that the beginning inventory in 2019 is overstated. Again, the beginning inventory in 2019 is the ending inventory in 2018. So if the ending inventory in 2018 is overstated by 3,000 pesos, it means that the beginning inventory in 2019 is also overstated. So what is the relationship of beginning inventory with net income? So going back with this analysis, beginning inventory is not an asset. It does not appear in the statement of financial position because what appears in the statement of financial position is the ending inventory. So, where do we see beginning inventory in the financial statements? So, beginning inventory is part of the computation of cost of goods available for sale, which is being deducted by ending inventory to arrive at cost of goods sold. So which means that beginning inventory is seen in the income statement as part of the cost of goods sold. And what accounting element is cost of goods sold? Cost of goods sold is a type of expense. So which means that the beginning inventory becomes part of the cost of goods sold when it is part of the income statement, and it is a type of expense account. And what is the relationship of an expense account with net income? So the relationship is inverse. It means that if the beginning inventory is overstated, it means that the net income is understated. Because again, the relationship is inverse. So it means that the 264,000 net income in 2019 is understated by 3,000 pesos. Again, the beginning inventory in 2019 is overstated. That is why 2019 net income is understated. And in order to convert the 264 net income to weighted average, we need to adjust the understatement. And that will be an addition of 3,000 pesos. So by adding 3,000 pesos to 264,000 pesos, we can convert the net income into weighted average. Then, since the 264 is part of the 514 retained earnings in 2019 and the 264 is understated, the question is the 514,000 pesos also understated? The answer is no. The 514 is no longer understated nor overstated. The 514 peso retained earnings is already at weighted average method as far as the 2018 ending inventory is concerned. And why is that? So the 514,000 pesos is already adjusted because the overstatement of the 2018 net income and the understatement of the 2019 net income, both for 3,000 pesos, were already close to the retained earnings at the end of 2019. It means that the overstatement of 2018 and the understatement of 2019 has already offset in the retained earnings at the end of 2019. That is why the retained earnings of 514,000 pesos is neither overstated or understated. Or, to prove mathematically, negative 3,000 is equals to negative 3,000 plus 3,000 is equals to 0. So that is why there will be no adjustment to the 514,000 pesos. And the 3,000 will also have no effect on the net income in 2020 as well as the retained earnings in 2020. Now let us proceed to the 2019 ending inventory. So this time, the ending inventory in 2019 under FIFO is understated by 1,500. Again, ending inventory is an asset because it appears in the statement of financial position. So again, the asset has a direct relationship with net income. And if the asset or the ending inventory is understated, it means that the net income in 2019 is also understated. And why is the 2019 net income understated? So let us analyze using this illustration. So the 2019 net income is understated because the ending inventory in 2019 is also understated because they have direct relationship. So to illustrate, if the ending inventory is understated, the cost of goods sold is overstated. Remember that the ending inventory is being deducted from cost of goods available for sale. That is why if the ending inventory deducted is lower, it will result to a higher cost of goods sold, therefore decreasing the net income. So that is why the net income in 2019 is understated by 1,500. And in order to adjust the net income of 264 to weighted average, we need to adjust the understatement, and that is by adding 1,500. And again, since the 264,000 pesos was close to the 514,000 retained earnings at the end of 2019, it means that the 514,000 pesos retained earnings is also understated by 1,500 pesos. So that is why the 514,000 pesos is not yet converted to weighted average. It means that we need to adjust the understatement of 1,500 in the retained earnings. So to adjust, we need to again add 1,500. Since the ending inventory becomes the beginning inventory in the succeeding years, so the beginning inventory in 2020 is also understated by 1,500. And again, beginning inventory becomes part of the cost of goods sold in 2020. So it means that the beginning inventory will become an expense. And between expense and net income, the relationship is inverse. It means that if the beginning inventory is understated by 1,500, it means that the net income in 2020 is overstated by 1,500. And why is net income in 2020 overstated by 1,500 pesos? That is because the beginning inventory is understated by 1,500. It means that the cost of goods sold is also understated. So if the cost of goods sold is understated, it means that the net income is overstated. So the 240,000 pesos net income is overstated by 1,500. And in order to adjust the overstatement of 1,500, we need to deduct 1,500. And again, the 1,500 is no longer have an effect on the retained earnings in 2020. That is why there will be no adjustment on the 754,000 retained earnings at the end of 2020, because mathematically that will be 1,500 is equals to 1,500 plus negative 1,500, that will be 0. Now let us proceed to the 2020 inventory. So based on our analysis, the ending inventory in 2020 is understated by 15,000 pesos. Again, ending inventory is an asset, and the relationship of asset with income is direct. It means that if the ending inventory in 2020 is understated by 15,000 pesos, the net income in 2020 is also understated by 15,000 pesos. So in order to convert the net income in 2020 to weighted average, we need to adjust the understatement, and that is by adding 15,000 pesos to 240,000 pesos. So does it have an effect on the retained earnings in 2020? Of course, there is, because the 240,000 pesos is understated by 15, and then it was close to the retained earnings. It means that the net income that was close to the 754,000 pesos is understated by 15. So again, to adjust the understatement, we need to add 15,000 pesos. So that is 15,000 is equals to 15,000 pesos. So now we are done with the analysis of the effects of the change in accounting policy for inventory. Let us now compute for the adjusted balances, which is already under weighted average method. So let us start with the 2020 retained earnings ending. So this is 769,000 pesos. Then the net income in 2020 is 253,500. Then in 2019, we have 515,500. And the net income in 2019 is 268,500. Then in 2018, we have 247,000 pesos, which is the retained earnings. Then for the net income in 2018, again, we cannot compute because there is no unadjusted amount. So this is our analysis of the effects of the change in accounting policy. So now we're done with this format. Let us compare. So based on our first procedure, the net income under 2019 adjusted based on weighted average is 268,500, which is also the adjusted net income in 2019, as well as the 2020 net income 253,500, which is also the adjusted net income in 2020 that we have computed. Now, in order to reflect these adjustments in the books, and in order to convert the books into weighted average, we need to prepare journal entries. And since the current year is 2020, the journal entries will be prepared as of December 31, 2020. So our adjusting journal entry would normally include the adjustments of the net income for 2018, 2019, and 2020. However, since the current year is 2020, the only books that are still open is 2020, and the books that were already closed are 2019 and 2018. So when we say the books are already closed, it means that the nominal accounts were already close to the retained earnings. That is why we can no longer use nominal accounts if we wanted to adjust the nominal accounts related to prior years, which in this case is 2019 as well as 2018. So the only nominal accounts that we can adjust are the nominal accounts in 2020 because the 2020 books are still open. Then again, since the adjustments would include the adjustments on net income, among the net income, 2020, 2019, and 2018, we can only use nominal accounts to adjust the net income in 2020 because the 2020 books are still open. However, for 2019 and 2018, since we can no longer use the nominal accounts, because these were already close to the retained earnings, it means that to adjust the net income of both 2018 and 2019, we must use the retained earnings account. That is why, based on the table, the adjustments will be taken from this particular column, the net income in 2020 and the retained earnings column in 2019. Again, this column pertains to the adjustment of the 2020 net income using the nominal accounts. However, for this column, retained earnings, we are going to adjust the retained earnings in order to convert the net income in 2019 and 2018 to weighted average method. So let us start now the adjusting journal entries. So first is the 1,500 inventory in 2019, which is an understatement. So the journal entry would be a deduction from net income, which is a debit. And what account or nominal account should be debited that is related to inventory in order to reduce net income by 1,500? Of course, the nominal account that would be related to inventory is the cost of goods sold, and that will be debited at 1,500. And another adjustment for the 1,500 is to increase the retained earnings by 1,500. And to increase retained earnings, it means we need to credit retained earnings for 1,500. The next journal entry would be related to the 15,000 pesos, and that is an addition to net income for 15,000. It means that we need to credit a nominal account in order to increase net income. The question is, what account should be debited? So since this is the understatement of 2020 ending inventory, and 2020 ending inventory appears in the statement of financial position, it means that the inventory in the assets section is understated. And in order to adjust the understatement of the ending inventory, we need to increase the inventory. And increasing inventory requires a debit of 15,000 pesos. And again, the credit would be the nominal account to increase net income. And such nominal account should be related to inventory, and that is cost of goods sold for 15,000 pesos. So based on these two columns, these are only the adjustments. So these adjustments prior to the retained earnings in 2019 were no longer adjusted in 2020 because these amounts no longer appear or reflect in the retained earnings at the end of 2019. So after we have prepared the adjusting journal entry, let us now prepare the statement of changes in retained earnings. So to start the statement of changes in retained earnings, so the first line item would be the retained earnings beginning, which is still unadjusted. Since we are preparing a comparative financial statement and the current year is 2020, it will be comparative side by side with 2019. However, the 2019 that will be prepared beside 2020 should already be based on weighted average method. That is why the effect of the change in accounting policy should reflect in the statement of changes in retained earnings. So again, the retained earnings beginning as the first line item is unadjusted, which is still at Fifo method. Then after this is the effects of the change in accounting policy. Then the retained earnings beginning as adjusted, which is already converted into weighted average method. Then add the net income, and since we have no dividend payments, the last item is the retained earnings ending. So now let us start with 2020. The retained earnings at the start of 2020, which is unadjusted, which is still at FIFO method, is 514,000 pesos. So this is the unadjusted retained earnings at the end of 2019 under FIFO method. And what is the effect of the change in accounting policy on the 514,000 pesos? That is 1,500. So the effect of the change in accounting policy on the 514,000 pesos is a 1,500 pesos positive in order to arrive at an adjusted retained earnings beginning in 2020 of 515,500. So 514 plus 15 is equals to 515,500. Then we will add the net income for 2020. So which net income would be added to the 515,500? So is it 240 or 253,500? So of course, based on this table, the amount of net income that was added to 515,500 is 253,500. So 515,500 plus 253,500 is equals to the ending retained earnings adjusted of 769,000 pesos. Now, let's proceed to the 2019 as revised. So starting with the retained earnings at the start of 2019, which is still at FIFO method, for 250,000 pesos. Again, this is the ending retained earnings in 2018. Then the effect of the change in accounting policy on the 250,000 pesos is a negative 3,000 pesos. So the effect is negative 3,000. Then 250 less 3,000 pesos is 247,000 pesos. And this is the retained earnings adjusted at the start of 2019, or the retained earnings ending in 2018. Then let us add net income. Again, which net income would be added to 247,000 pesos? So the net income, since the 247 is adjusted, the net income that must be added is also adjusted. So that is 268,500. So 247,500 plus 268,500, that will be 515,500, which is the adjusted beginning in 2020 or the adjusted ending in 2019. So this is our discussion on the accounting treatment if there is a change in accounting policy. Again, this is under PAS 8. So this is the second part of our discussion of PAS 8, and the last topic under PAS 8 is the correction of prior period error, which will be discussed in a separate video.